Welcome back to Wealthwise, the podcast where clarity meets strategy. Have you ever felt like you're living in a completely different economy than the one you read about in the headlines? On one hand, you hear that the stock market is booming and unemployment is low. But on the other, your grocery bill is higher, your rent is climbing, and achieving real financial momentum feels harder than ever. You are not alone in feeling that disconnect. Today, we are diving headfirst into this paradox. Our topic is the confused economy, why the reports look good, but your wallet feels empty. And to help us make sense of it all, we have the perfect guest. He's the brilliant mind behind the acclaimed financial newsletter Market Briefs and a macroeconomic analyst who has a unique gift for cutting through the noise. Please welcome the founder of Market Briefs, Max Wise. Max, it's a real pleasure to have you on this show.
Sarah, thanks so much for having me. It's a critical topic, and I'm excited to get into it.
Absolutely. And for everyone listening, by the end of this episode, you will walk away with a crystal clear understanding of three key things. First, why those glowing economic indicators often hide the deep cracks forming just beneath the surface. Second, the real battle happening inside the Federal Reserve over interest rates and how every decision they make directly impacts your loans, your savings, and your future. And most importantly, how to turn this market uncertainty from a source of anxiety into a powerful opportunity for your portfolio. So, Max, let's jump right in. We have this huge contradiction playing out. The data says things are strong, but the collective feeling, the public sentiment, is one of financial pressure, especially for younger generations. In your view, why is this topic so misunderstood?
So, Sarah, it's important to understand that there are two stories being told, the one that the stats paint and the one that real people are experiencing. The data, always following the law of averages, shows things are good. Unemployment low means that almost everyone who wants a job has one, but that's still about 25% of functional unemployment. And employers realistically think it could be closer to 8%. So under our model, we rely on predictable incomes to influence spending, and we're really lacking is the ability to up-level our incomes right now. So now that we've filled the majority of the roles needed at the current pay level, where people are lacking is the ability to up-level to really start generating return capital as loans and spending add up. So you still have that mid-tier pressure from cost. What is the feeling that people have when they feel like they can't advance their wages and find their permanent career is really just that feeling of being stuck in first gear.
That's such a powerful way to frame it. The functional unemployment idea perfectly captures that feeling of being stuck in first gear. So that's the psychological side of the coin. What about the math?
The math is even more brutal, and it spares no one. This is where the feeling of being squeezed becomes an undeniable reality. Let's look at the hard numbers over the last 5 years. Cumulative inflation in the United States, the rate at which the cost of everything from gas to eggs has gone up, has been roughly 24%. Now, what about wages? We're told wages are rising, and they are. But over that same 5-year period, average incomes have only gone up by about 20%. That 4% gap is the silent thief in your pocket. It doesn't sound like much, but that's the deficit that eats away at your life. It's why your grocery bill feels shocking, why your rent increase stings more than it used to, and why saving for a down payment feels like trying to fill a bucket with a hole in it. Your paycheck is literally being outrun by the cost of living. Your financial pie isn't growing fast enough to cover the slice that inflation is eating every single day. So you have this two-part problem, a phenological gap from underemployment and a real mathematical gap in your purchasing power. And Sarah, this is all before we even start talking about the bigger invisible forces pulling the strings. Things like tariffs, global supply chains, and the enormous, almost impossible pressure being placed on the Federal Reserve right now. And that's really where the story gets interesting.
Max, you ended our last segment on a very intriguing note. You laid out the psychological and mathematical reasons why people feel squeezed, the functional unemployment and the wage inflation gap. But then you mention these bigger, invisible forces pulling the strings. Let's unpack that. Beyond the inflation we see on the price tag, what's another one of these hidden economic pressures that's quietly impacting everyone's wallet, but isn't always front-page news?
Absolutely. The biggest one, and perhaps the most misunderstood, is tariffs. We hear the word on the news and it sounds like this high-level political chess match between countries. But in reality, a tariff is simply a hidden tax that finds its way into every household. It's like a sales tax that isn't listed on your receipt, but you are absolutely paying for it. Here's how it works, broken down simply. Let's say a big American retailer, like a Target or a Walmart, wants to import a popular electronic gadget from a factory in Asia. The government then slaps a tariff, let's say 25%, on that product as it enters the country. Now the retailer is stuck. They have to pay that extra 25% cost, and this leaves them with two very bad choices.
And I imagine both choices eventually lead back to the consumer?
Precisely. They are two different paths to the same destination, your wallet. Path A, which is the most direct, is they pass that cost on to you. The gadget that was supposed to sell for $100 now gets a $25 price hike, and it's listed at $125. You, the consumer, pay the tariff directly. You might not see the word tariff on the price tag, but you feel it. This is straightforward price inflation. But path B is more subtle and in some ways more damaging to the broader economy. To stay competitive, the retailer decides to absorb the cost. They keep the gadget priced at $100 and just accept a smaller profit margin.
On the surface, that sounds good for the consumer, right? The price doesn't go up.
In the immediate short term, yes. But think about the ripple effect. That retailer now has 25% less profit from that product line. What does a business do when its profits shrink? It tightens its belt. That means less money for employee raises. It means they might freeze hiring for new positions. It means they delay plans to open a new store in a new town, which would have created jobs. It means they cut back on research and development for new products. So you might not pay for the tariff at the cash register, but you pay for it through stagnant wages, fewer job opportunities, and less innovation. Either way, tariffs act as a drag, a handbrake on the economic engine. Right now, many businesses are on path B. They're absorbing the cost to avoid scaring away customers. But that can't last forever. Eventually, that pressure has to be released, and it will almost certainly be in the form of higher prices.
So it's an invisible headwind, slowing everything down even when it looks like we're moving forward.
That's the perfect way to describe it. It's a fundamental crack in the foundation that you don't see until the walls start to show signs of stress.
I think that's our highlight right there. The economic data can paint a picture of blue skies, but your personal bank account is the real weather report. And right now, it's forecasting a storm. That brings us perfectly to the institution at the center of this storm, the Federal Reserve. They are tasked with navigating these chaotic waters. And lately, there seems to be a huge amount of disagreement and hesitation coming from them, especially around cutting interest rates. In this incredibly complex environment you've just laid out, with underlying inflation, functional unemployment, and the pressure of tariffs, why does the Fed seem so paralyzed?
They're paralyzed, Sarah, because they are walking the most treacherous economic tightrope in modern history, and there's no safety net. To understand their dilemma, you have to remember the Fed's two mandates, their two primary jobs given to them by Congress. Job one is to maintain stable prices. That means keeping inflation under control. Job two is to achieve maximum employment. That means keeping the economy strong so people have jobs. For most of history, those two goals have worked in concert, but right now they are in direct, brutal conflict. The Fed is in a classic damned if you do, damned if you don't scenario. Let's play it out. Scenario one, they cut interest rates. Why would they do this? To stimulate the economy. Cutting rates makes it cheaper to borrow money. It encourages people to get a mortgage and buy a house. It encourages businesses to take out loans to expand and hire more people. This addresses the maximum employment part of their mandate.
Which sounds like what everyone wants them to do.
Exactly. It sounds like the obvious solution. But here's the problem. We just discussed how inflation and tariffs are already putting upward pressure on prices.
Cutting interest rates and flooding the economy with cheaper money in that environment would be like throwing gasoline on a smoldering fire. It could ignite a second, more vicious wave of inflation, destroying what's left of people's purchasing power. They would be solving one problem by creating a much bigger one.
Okay, so that's the risk of cutting. What's the other side of the tightrope?
Scenario 2. They hold interest rates steady or even hint at raising them. Why would they do this? To kill inflation for good. High interest rates are like a cold shower for the economy. It makes borrowing expensive, so people and businesses spend less, which cools demand and brings prices down. This addresses the stable prices part of their mandate. But the risk here is just as severe. We're already seeing signs of the economy slowing down. Businesses are struggling with high borrowing costs. Anyone with a credit card balance or an adjustable rate mortgage is feeling the pain. Keeping rates high or even raising them could be the final push that tips a slowing economy into a full-blown recession. That would mean widespread layoffs, business failures, and a huge blow to their maximum employment mandate. So they are caught. They are trying to land a 747 on an aircraft carrier in the middle of a hurricane. Any move they make has the potential for catastrophic failure. Add in the immense political pressure from all sides, and paralyzed becomes a very understandable state of being. It's a perfect storm. The Fed is walking a tightrope, cut rates and risk an inflation inferno, or hold steady and risk freezing the economy solid. There is no easy answer.
Okay, Max, this is a masterful, if slightly terrifying, breakdown of the chaos. You've painted a clear picture of the forces at work. So now, for everyone listening, the person in their late 20s trying to invest their first dollars, or the person in their late 30s trying to build real wealth, who feels a bit overwhelmed by all this, let's pivot. How do we shift from being a worried passenger in this chaotic economy to being a savvy pilot of our own finances? What is the playbook for not just surviving, but potentially thriving in this uncertainty?
This is the most important part of the conversation. This is where we shift from diagnosis to prescription. The biggest mistake people make in times like these is that they react emotionally. The goal is to act strategically. Wall Street hates uncertainty, which is why markets become volatile. But that very volatility creates opportunity for those who are prepared. The playbook isn't about complex trading strategies. It's built on 3 timeless, fundamental principles. Principle number 1, cash is not trash. It's ammunition. You need to hold more cash than you think you do. And I want to be crystal clear, I am not talking about your 6-month emergency fund. That money is sacred. It's for life's real emergencies like a job loss or a medical bill. I'm talking about a separate pool of capital, an opportunity fund. In a stable bull market, having too much cash can feel like a drag on your returns. But in a volatile market, cash gives you power. It gives you flexibility. Warren Buffett's famous advice to be greedy when others are fearful is great, but you can't be greedy if you're broke. Cash is the tool that allows you to act on opportunities that panicked sellers are giving you.
So it's about shifting the mindset from cash as a safety net to cash as an offensive weapon.
Exactly. It's your dry powder. Principle number 2, reframe market downturns as discount sales. This is purely a psychological shift, but it's a game changer. If your favorite high-end clothing store announced a 40% off sale, you wouldn't stand outside wringing your hands in panic. You'd rush in with a shopping list. Yet when the market, which represents ownership in the world's most innovative and profitable companies, goes on sale, people panic and sell everything. It's completely irrational, but it's human nature. The strategic investor does the opposite. They have a pre-made shopping list. This could be a list of 5 to 10 high-quality blue-chip companies they've always wanted to own, or a couple of broad market ETFs like an S&P 500 index fund. When the market dips 10, 20, 30%, they don't see a crisis. They see their shopping list on sale. They deploy the cash from their opportunity fund and buy quality assets at a discount.
And the final principle?
Principle number 3, and it's the most important. Know your time horizon. This is the North Star that should guide every single decision you make. The failure to respect your time horizon is probably the single biggest destroyer of wealth for individual investors. Let me give you 2 quick profiles. First, we have a 25-year-old saving for retirement in 40 years. For her, a market crash is a gift. It's the best thing that could happen to her. She has decades to recover, and every dollar she invests now gets to buy assets at a massive discount, supercharging her long-term growth. But now let's take a 45-year-old who is saving for a down payment on a house they want to buy in 2 years. If that person has their down payment invested in the stock market, a crash is an absolute catastrophe. It could derail their life plans entirely. That money should be somewhere safe and stable, like a high-yield savings account or short-term treasury bonds. Your strategy, your risk tolerance, and your reaction to volatility should all be dictated by when you need the money. Ignoring your time horizon is like trying to fly a plane using a map for a submarine. You're guaranteed to end up in the wrong place.
So, have an opportunity fund, view downturns as a sale, and let your time horizon be your guide. It sounds so simple, but it's incredibly powerful.
It's simple, but not easy. It requires discipline and the ability to control your emotions when everyone around you is losing their minds.
I love that. The perfect way to summarize this section is something you hinted at earlier. Market volatility isn't a risk to be feared, it's a wealth transfer mechanism from the impatient to the prepared. Max, that 3-part playbook, having an opportunity fund, reframing downturns as a sale, and mastering your time horizon, is incredibly logical. It's the kind of strategy that makes perfect sense when we're sitting here calmly discussing it. But we both know that when the markets are in a free fall and your portfolio is bleeding red, logic is often the first thing to go out the window. Fear is a powerful, primal emotion. So I have to ask you, on a more personal level, was there a turning point in your own financial journey, a failure or a breakthrough that taught you a lesson about this that you could never have learned from a textbook?
There absolutely was. And it's a story I don't often share, but it was the single most defining moment of my financial life. It was 2008. I was a young analyst back then. I was smart. I had aced all my exams. I could build complex financial models in my sleep. And frankly, Sarah, I was arrogant. I thought I had the system figured out. My personal portfolio was doing well, and I felt invincible. I saw the early warning signs of the subprime mortgage crisis, but like many, I thought, this is a containable issue. The markets are resilient. Then, Lehman Brothers collapsed. And it was like the floor of the entire global financial system just vanished. I'll never forget the feeling. It wasn't just numbers on a screen anymore. This was fear. Real, palpable fear. I'd come into the office every morning, and the Bloomberg terminal would just be a sea of red. Down 3%, down 5%, down 7%, day after day. My own portfolio, which I had been so proud of, was getting annihilated. I was down 20%, then 30%, then nearly 40%. Every rational thought I had, every model I'd ever built told me, this is an overreaction. These are good companies now trading at insane discounts. But my emotions were screaming something else entirely. My stomach was in a knot for weeks. I couldn't sleep. All I could feel was the visceral pain of losing.
So what did you do?
I did what millions of panicked investors did. I capitulated. I remember the exact day. The market had another brutal drop. I looked at my account and I just couldn't take it anymore. The pain of seeing that number go down one more time was unbearable. So I sold. Not everything, but a huge portion of my holdings. I sold some of the best companies in the world at the lowest prices they'd seen in years. And the moment I hit sell, I felt this wave of relief. The pain stopped. I'd protected what was left. That feeling of relief lasted for maybe a day.
What happened after that day?
Regret. A profound, lasting regret. Because a few months later, in the spring of 2009, the market bottomed.
And then it began the longest, most powerful bull market run in modern history. The very assets I had sold out of fear not only recovered, but went on to generate astronomical returns. The money I lost was significant, but the real loss, the lesson that was burned into my soul, was the opportunity I had thrown away. I had the knowledge, I had the data, but I let my emotions hijack my decision-making. I failed the most important test. That experience taught me the single greatest lesson in investing. Your financial success is determined less by how smart you are and more by how you behave. It's about temperament, not intellect. It taught me that the real cost of panic isn't just what you lose, it's what you fail to gain. Since that day, I've built my entire financial life and my investment philosophy around a single principle. Preparing myself psychologically is just as important as preparing my portfolio financially, because the next crisis is always coming, and the only variable you can truly control is yourself.
Max, thank you for sharing that. It's a raw and incredibly valuable lesson. That psychological fortitude you're talking about is the bridge between knowing what to do and actually doing it. So let's use that forward-looking lens. You've navigated crises, and now you analyze future trends. As you look out over the horizon, say the next 3 to 5 years, what is the one major shift you believe will define financial success for the next generation? Something our listeners should be paying attention to right now.
I believe we are at the very beginning of a profound structural shift in how we think about wealth. I call it the rise of the ownership economy. For the last 70 years, the dominant model for financial security was to be a good employee. You worked hard for a company, you got a steady paycheck, and you saved a portion of it. You were fundamentally a consumer and a saver. But as we discussed earlier, that model is breaking down. Inflation is eroding savings, and wages aren't keeping pace. Being just a consumer and a saver is a losing game now. The winning strategy for the next decade and beyond will be to shift your identity from a consumer to an owner. It's no longer enough to just earn money. You have to own the things that make the money.
What does that look like in practice? Are we just talking about buying more stocks?
It starts with stocks, but it goes so much deeper. Technology is democratizing ownership in ways that were unimaginable just a decade ago. It's about a mindset shift that asks, how can I own a piece of the value I help create or the products I consume? Let me give you a few concrete examples. Fractional ownership. You love fine art, but you can't afford a Picasso. Today, you can use platforms like Masterworks to buy a fractional share of a multi-million-dollar painting. You don't just admire it, you own a piece of its potential appreciation. The same is happening with real estate. You might not be able to afford an entire apartment building in Austin, but you can use platforms like Fundrise or Arrived Homes to buy a share of one and earn rental income. The digital assets and Web3. This is the bleeding edge, of course, but the core idea of Web3 and decentralized finance is ownership. It's about owning your data, owning a piece of the networks you participate in, rather than just being a user on a platform owned by a giant corporation. The core idea is this: in a world where your labor is being devalued by inflation, your capital has to work harder. The most direct way to do that is to own productive assets, be it a share of a company, a piece of real estate, a stake in a creative project, or a part of a digital network. This isn't just an investment trend, it's a survival strategy for the new economic era. Let me put it this way. In the last century, your career was your primary wealth-building tool. In this century, your portfolio of owned assets will be. That's the fundamental shift.
From consumer to owner. That is a powerful and actionable reframing for all of us to take away. Max, this has been an incredibly insightful hour. You've given us so much clarity on a topic that feels intentionally confusing. From understanding the two-faced economy and the Fed's Tightrope Act, to providing a concrete playbook for navigating volatility, and finishing with a look at the future of the ownership economy. This has been a masterclass. Thank you so much for your time and your wisdom today.
The pleasure was all mine, Sarah. Thanks for having me.
And for everyone listening to WealthWise, if you found value in today's conversation, and we hope you did, we have 3 simple requests. 1, share this episode. Please think of one friend or family member who is also feeling confused or anxious about the economy and send this to them. A clear conversation can make all the difference. 2, subscribe to WealthWise wherever you get your podcasts so you never miss these weekly deep dives into building your financial future. And finally, let us know your thoughts. What was your biggest takeaway from this episode? Do you have a personal story about navigating volatility? Leave a comment or review. We read every single one. Thank you again for joining us. And always remember this final thought. Financial freedom isn't about perfectly predicting the future. It's about building a financial fortress so strong that you don't have to. We'll see you next week.